Welcome back. I'm Edward Sanchez, and today's lesson is on our economy. This is big. There are a lot of points and pieces to walk through with you. I will tell you that if you're wondering why this is important, is because you are such a vital part. You and I are such a big part of the economy and how it functions. So understanding how it works will make more sense when you're reading the news and learning about what the $2 trillion aid package is doing, or what it's supposed to do and impact, how it's supposed to impact our economy. And you'll also have a better understanding of the quantitative easing that the Federal Reserve is doing right now to try and help the economy stay robust and continue to move along. So let's start with the parts of our economy. Now, I'm going to give you a lot of information. I'm going to put it up on this board. If I'm writing up here, I recommend you should be writing it down as well. So you should have a piece of paper and a pen on hand or a pencil, and you can pause and rewind it any step along the way. If you have any questions, raise your hand and I'll try to get to those as well. We're going to start with our banking system. So this is our banking system. This is the Federal Reserve. Here, we have companies like Target, McDonald's, and Walmart. And then over here, this is you and I, this is us. Okay, so let's go through all of this together. When we look at the banking system, we have a number of different types of banks. First, we have our retail banks. Now, the service that retail banks offer, this is where most of us, you and I, are going to go, and we are going to, let me back up. These banks rely on deposits from, you guessed it, from us. So they use our deposits, and in turn we get from them services like checking, savings. You can get a certificate of deposit there, and then you can also get mortgage, regular loans, car loans, and credit cards. So that's the service that retail banks offer us, and we use these banks. Next, we have investment banks. So investment banks offer different services. They're going to work with large corporations and businesses when they're looking to, for example, create an IPO, or if they'll work on mergers and acquisitions. That's a lot to write in here. So they'll work on mergers and acquisitions. They'll also do corporate bonds. So when businesses such as McDonald's, Walmart, when they want to raise funds by issuing bonds, they'll go to investment banks and they'll use them for these number of different services. And then we have commercial banks. And commercial banks, also known as or corporate banks. So these banks offer similar services to retail banks, but they work with the big boys. So what they help with are things like, again, loans for businesses that want to expand and grow. They can also help them with payroll. They can help them with loans for payroll. They might help them with their 401k management. They might help them with their insurance and services such as this. So we're going to have retail banks, investment banks, and commercial or corporate banks. Now, these businesses are going to use these banks. We are going to invest and also use this money, these resources. These businesses hire us and they employ us, and then we go and we spend money at these businesses. So if you're starting to get the idea here, is that all of this works together. Now, here we have the Federal Reserve, also known as the central bank. And what is the role of the Federal Reserve? What purpose do they serve? Well, the Federal Reserve has two primary goals, and we're going to write those down. The first has to do with unemployment. The Federal Reserve wants to work and try to keep unemployment at 3%, at about 3% or below. Second has to do with inflation. So the Federal Reserve wants to keep inflation at or below 3%. And so when these businesses hire us to work, we will then spend money at these businesses, and we'll borrow money for mortgages and we'll invest our money. So what happens is that we will see money flowing and moving throughout the economy. Now, these banks lend money to each other overnight, and the Federal Reserve sets interest rates for our banking system. In order to accomplish keeping unemployment at or about 3%, and keeping inflation at or about 3%, the Fed has two tools that they use in order to manage this. Now, before I get ahead of myself, what we do, when I point to us on this chart, what we do is that we provide goods and services. And all of this represents the goods and services of our market. Now, what is a good? A good is tangible. It can be put in a box. It can be put on a shelf. And it can be transported on a plane, a train, or a truck. It means it can be moved. So that is a good. What is a service? Well, a service is something someone does for someone. Get it together. Something someone does for someone else. All right. So all of this economy runs on goods and services. McDonald's is providing the service of cooking food and making fast food, but the good is the food that goes out the drive-through window. Walmart is a store filled with goods that we buy that are created in factories where consumers work, where employees work. So the cycle continues and it moves around. Now, overall, the way we measure what's happening in this market is what we call GDP. What's GDP? GDP is gross domestic product. That's squeezed in there. Gross domestic product is going to be the sum of all goods and services produced in a country. So it's really produced in a country over a period, within a specific period of time. So we can measure, we can look at the GDP of the United States in the first quarter of 2019 and compare that to the GDP of the United States in the first quarter of 2020. Or we can look at the GDP of the US in 2019 and compare that to the GDP of China in 2019 to compare one country's economic growth versus the economic growth of another country. All right, so we have goods, we have services, we have our GDP, and then we have all the tools and the pieces of our banking system.